Welcome to the video on regulations of the financial institution sector. Yes, finance is one of the most important criteria in today's life, world, and living. All about it. If we do not regulate it, things might go array. The social structure might crumble down altogether. So, yes, regulation is very much important. Financial institutions are one of the most heavily regulated businesses in the whole world. I have already stated my position. If it is not regulated, the whole society will crumble down. Many economists, financial analysts, and financial institutions have argued that the regulations have done more of a harm than that of the good. I differ. Other observers, however, argue that government regulation have achieved somewhat positive result, which is true in all extent for the financial institution as well as the general public per se. The reasons, what are the reasons behind this regulation of financial institution? Concern for the safety of your money, my money, everybody's money, the public fund, to promote public confidence in the system, in the governance, to ensure equal opportunities, equal fairness in public access to the financial services, to prevent excessive money laundering, or if I may say, money creation, and thus excessive inflation, to aid disadvantaged sectors of economy, the poor section, the weaker section of the society, to enable and ensure that important financial services are provided reliably and at a much more reasonable cost. So, does regulation benefit or probably harm the financial institution? Regulations can benefit the financial institution. Remember this. This is very important. Regulation subsidizes the growth of the financial institutions and protect them from competition. Regulations tends to increase public confidence. Regulation spawns innovative escapes, regulatory dialects through loopholes in the regulation. Thereby, we are talking about regulation. Regulation, obviously, if it has good things, it can harm the financial institutions, as in it might dialects or are not the most productive form of innovation. Remember, regulatory dialects are not the most, at times it crumbles competition. At times it becomes much more protective for a particular industry to sustain or survive. The time and energy spent on regulation compliance activities are itself very costly because it is a time consuming activities, and everything that consumes time will always eat into your money. The regulation of commercial banks, due to their importance in the financial system, commercial banks are typically the most regulated of all financial institutions. Responsibility for regulating banks operating in the US today is divided mainly into three federal agencies: the Federal Reserve System, the Controller of the Currency, and the Federal Deposit Insurance Corporation. These three state banking commissions absolutely goes to the length and the breadth of the United States, all the 50 states per se. The Federal Reserve System supervises and regularly examines all member banks operating in the US, imposes several requirements, including the reserve requirement on deposit held on all depository institutions, and grant temporary loans of reserve through its discount window. Must approve all application of member banks to merge establish branches and exercise trust power. Now, what am I saying and showing it to you is what has been done in the most developed country in the world, as in the US, United States of America. And I am sure wherever you are accessing my video from, you are actually seeing it within your country. There is a regulatory body which is managing the banks and the financial institutions. The body usually prints currency notes for the country and so on and so forth. So, what are we looking into it? The Federal Reserve System supervises international banking corporation organized by US banks and foreign banks operating in the US, regulates and examines all banking and financial holdings companies in the US, conduct monetary policy to control the growth of money and the credit in the financial system. Office of the Controller of the Currency issues charters for new national bank, regulates, regularly examines all national bank, must approve all national banks application for a new branch offices, trust power, merge and consolidate, declares insolvent national bank closed as of. So what are we looking into? We are talking about insurance of insuring deposits of saving institutions, as in thrifts, and the banks conforming to the regulation up to $100,000 and act as a receiver for all nationalized banks declared insolvent, and for state banks if requested by the State Banking Commission, whether it's a private bank as in a national bank or the state bank as in the nationalized bank, if they feel that they are not conforming to the regulation, they can actually uh, take away and probably put stipulated guidelines, in fact, stipulated restriction on their operations altogether. So must approve application by insured banks to set up branches, merge, or exercise trust power. Requires all insured banks to submit reports on their financial conditions thereby. State banking commissions issues charters for new state banks. Supervises and regularly examine all state chartered banks. Approve application by state banks to form a holding company or establishes a branch, declare insolvent. Remember, this is where you're talking about business being insolvent altogether, or business insolvency proceedings has to be initiated. State chartered banks closed and appoint a receiver to liquidate, otherwise dispose of the assets of the failed bank. The new geographic market that banks can enter have to be tightly controlled thereby. It was believed until quite recently that too much of competition could lead to excess volatility in the bank profit and introduce instability into the nation's banking system, thereby endangering the savings of the depositor. Regulation of the service bank can offer controlling the service bank. Remember, regulation controlling the service bank can offer have also been tied out of concern for bank safety and a desire to protect certain non-bank financial institutions from tough banking competition. I'm talking about the Banking Act in 1933 by Glass-Steagall Acts, the Financial Service Modernization by Graham Bell, Leach, and Bellali Act in 1999. So, the rise of disclosures laws in banking, one rapidly expanding areas of US banking regulations today is concerning disclosure. We have to say about what we are doing as far as operations are concerned. Let's say 1968, the Truth in Lending Act, to whom you are giving, at how much rate, Home Mortgage Disclosure Act in 1975, what are the hidden charges that you're looking into it? Community Reinvestment Act 1977, something like corporate social responsibility. Truth in Saving Act, as in what of the interest that you are giving as a payout. FDIC Improvement Act in 1991. Financial Service Modernization, Graham, Leach, and Bilali Act in 1999. The unfinished agenda of the banking regulation. Slowly and steadily, banking is experiencing an era of deregulation as legal constraints are lifted on a variety of banking activity. Supervisions of the financial institution in the future will rest primarily upon government examination of market data and firms' risk management system, the capital requirements, and the market discipline as on when on basis. The regulation of thrift institutions, credit unions, chartering, National Credit Union Administration (NCUA) of the states, new branches, no approval required, mergers and acquisition NCUA by the state as and when on basis, deposit insurance, what we are looking about as far as NCUA, share insurance fund per state for every state. Supervisions are for every state that the National Credit Union Administration is doing it. Remember, this is what we are talking about in NCUA, National Credit Union Administration, and this is pertaining to the United States of America. Depository Institution Regulation and Monitoring Act, which was established in 1980. Now we're talking about the Thrift Institution, Savings and Loan Association, Chartering, Office of the Thrift Supervisions per state of every state. Remember, OTS is Office of Thrift Supervisions. New branches, OTS, FDIC, every state that we go around it, mergers and acquisitions, which has to be followed. Similarly, for deposit insurances, we are talking about supervision for every state, Office of Thrift Supervisions. Financial Institution Reform, Recovery and Enforcement Act was established in 1989, which is just an improvement, which was just improved by FDIC Improvement Act in 1991. Now, look at the saving banks. The chartering is OTS again, Office of Thrift Supervision for every state. New branches, as has been stated, mergers and acquisition is already the same thing. Deposit the same, supervision is also same. Now talking about the money market acts, chartering is SEC, Securities and Exchange Commission, very important. This is where the stock market has been regulated as an NYSE and NASDAQ. So new branches, no approval required. Mergers and acquisition, absolutely not required. Deposit insurance, no government insurance is required. Supervisions is done by SEC, the Securities and Exchange Commission, thereby. While not quite as heavily regulated as commercial bank, insurance company, remember insurance company intermediaries face tough regulatory rules that are imposed primarily by state insurance commission as on when on basis because pension funds have risen rapidly to hold a bulk of the retirement savings of a worker. They are heavily regulated by the courts and the government agencies as of today. We are talking about Employee Retirement Income Security Act ERISC, SA 1974, Pension Benefit Guaranteed Corporations, or Penny Penny, if I may say so, are federal agencies altogether. Remember, the regulation of financial companies is at the state level, at the provincial level, and focuses principally upon the consumer loans. The investment companies of the mutual fund are regulated predominantly by the federal government in the US. Securities and Exchange Commission, Investment Company and Investment Advisor Acts in 1940. The trends in the regulation of the financial institution. Regulation seeks to promote the safety, the stability of the financial institution in order to preserve the confidence of the public and avoid institutional failures. However, regulations can become costly, burden that significantly increases the operating cost of the financial institutions and limit the cleansing effect of the failures and competition thereby. So, increasingly, what are we watching? What we are seeing that market discipline is playing much better and a prudent role. Regulators are cooperating more and more because of the distinction between financial institutions are getting blurred. Everybody, the bank is selling insurance, insurance is giving somewhat of a return in, which is comparable to a fixed deposit, and so on and so forth. The focus of regulation is moving away from control over the service offered and the geographical expansion to controlling the risk taking capacity. And there is an increased attention toward disclosure, transparency for the public, general public. With these words, I come to an end of this video. Thank you for watching it.